Okay, so today I think is slow. It was kind of boring because the pieces of the puzzle didn't quite, they just took forever. So let's take a look at what happened today. The first thing that happened was you see velocity dips down, you cross, and if we get the crosshairs on here so you can see just right where it crossed over right there, you can see that the volume didn't happen right there, so you had to wait, and here was the volume. And so this was a bit of an unstructured signal where the volume didn't quite line up with the signal, meaning the way I interpret that is that the group of people who decided to trade it, take the backside of it, provide liquidity, sell it, they just took a little while. Anyway, right there we have our bullish liquidity comes into the market and it shoots back up. Now the big problem right here is that if you look over here with tension, there wasn't really impact. The bulls weren't doing anything. And the bears easily could look at this as the bulls stepping out of the way a little bit because they didn't impact tension. So the bears are going to be thinking, elastic. Is this going to get elastic? Is that what's going on? Are the bulls moving? Can the bears come in? Well, we had a price response. So this decent price response tells you that there was some activity there. And then you could see that tension just sort of makes its way down. And I think in this situation, what I'm looking at is to find the bears and see what they're going to do. And I think that these bulls here basically didn't have an opponent. Like, who are you going to run out? Who is there to take out? And there really weren't any bears anywhere to take out going through this section or before. So what it looks like happened is the market just started looking, and we get stuck in this sort of go nowhere range type of thing. And finally, it took all day, and right here, we get our first sample and no volume. It leans down a little bit, we get this bullish sample, and then it pops back up, and we finally get some bears right here. Now, there's one really important event that happened between the bullish sample in the morning and the bearish sample here that's important, I think. Let's take a look at that. This is an insurance policy for the lows, and it was a pretty decent sized one. Usually we see this type of thing, 200, 300. You can see right there that's dark red. It means it's greater than 1,000. And in this instance, it just is 1,000. Well, it's greater than 999. Greater than or equal to. So we have a huge insurance policy insuring this position, meaning that's really going to be difficult to break that low. And if the market had gotten down to this low, it would have needed another buyer to be able to push through. Otherwise, it would have been immediately rejected. Those bulls insured their position, but there was no bears to take out. So I think the market was looking for bears. It just sort of hung out in this range because there weren't any to find. So that was this section here. And then finally we get a bearish position right here. Now, I think at this point, you should know how I think this is going to go. You say to yourself, we have bulls in the lows. Their position is insured, which creates a lot of support for those lows. These bears are screwed. There's just like, even if they tried really, really hard and they ran programs and it got all, it wouldn't work because the insurance, and remember, that's a decent size, 1,000. We'll watch this for a while. 200 or 300 is pretty good. 1,000, well, in that case, it was about 1,500 contracts. That's really good. These guys right here, no chance. So I think at this point, what is happening is this group and this group of bulls are simply hunting or predatory. They're looking, they're just waiting for bears to come in so they can liquidate them. That's it. There's been nothing else since that insurance policy happened right here. Just the bulls got a position, they insured it, so this is sort of locked in, and then they're just waiting. And the bears finally showed up here, and it looks like the thing the bears were after was just, was above this area at the morning highs, or I don't know. I don't know what they're looking at, but whatever it was, the bears were able to get a sample. And looking at tension, the bears did nothing, so there's likely just shadow bears here, meaning it's individuals who trade like institutions but don't have the ability to impact tension because they're not big enough. And those guys are going to pay the price, and we're going to watch when they do pay the price, tension's going to curl, so you'll see it sort of accelerate upward. And at that moment, you go, okay, there they are. They got liquidated. You could look at this and say, well, where would you put your stops? I don't even know. Probably just, here's the highs off the, probably just sitting right up here. That's where I would have my stops. And the reason that I would hover them up here like this is because you see this, how it's sort of a pin bar. And one of the fears that you have with a pin bar, and when I say pin bar, I don't mean this. I mean, I kind of do. What I mean is this type of motion, not the price action. And you could tell it was like, it popped up. And the thing that typically happens is markets love to retest to the tick. So you'd want to hover your position a little bit above it so you don't get, one ticked, which is the most annoying thing on the planet, where you get stopped out right at the high or right at the low, and you get one ticked out. You don't want that. So you're going to hover it a little bit, and that's where their stops are going to be sitting at. As for the bulls, I don't know why the bulls would have a stop. They totally insured their position. There we go. They insured their position, so they don't need stops. If the market goes down, their premiums from the options are going to cover out the losses from their longs. So they captured gains, and they leveraged that capture to increase their upside potential. So we're going to see that. Keep your eye here on tension. Another feature that I want to talk about, because it's a little bit newer with tension, is this projection line. And you could see, now I have it dialed back to be a number that's, or a plot that's not super easy, because I think it's visually distracting to see stuff like that. So I wanted it to be less captivating, like it doesn't pull your eye to it. So that's why I picked a dulled number. I know that I gave it to a few people, and as soon as the update came out, they switched it to these really bright colors. I get that, but I'm going to zoom in a little bit just so we can get, I have it on the other axis, so we'll just do it like this. Take a look at this. The whole time, this was projecting a close, but it never got to the other side of zero. The market was never actually projecting 30-minute tension crossing under zero. And the reason for that, I think, is we didn't have bears. If we'd had some bears right here, or maybe some bears over here, and they got elasticity and they had hit, what would have happened is this would have accelerated down, and I think we would have seen the projection move under zero, basically showing the intent of the bears to drive it under zero for the day. But we didn't have bears all afternoon, and I think you can see that here. There were no bears, so the market really didn't show us that it was ever planning on crossing over zero. And that would have been the mechanism the bears used today, was elasticity, drive it down, try and get it through zero. Okay, so look at that. We get right up to about that level. You sort of hovered up here. I still think it's in the I got one ticked out kind of zone. If you've been in this situation where the wrong side is trying to one tick you, this is just the worst. It is the worst to be upside down in a market that's can play games with you. And in this situation right here, that's the most likely thing because of this pin bar situation here. It's going to be like one tick, well, a little bit higher, oh, falling back down, and it's like, wait, was it just two legs up? Is that what it was? Just two? Oh, it's just this, and it really like logically will twist you up. If you don't have some broader premise, then this is going to price action game you like crazy. Looking at tension right here, does that look like it accelerated up? Like maybe a little bit, accelerated up a little bit there. I think this is probably toying with people who are upside down in their position. We know where they are. They're sitting here. In fact, I'll mark that. I'm gonna mark it over here. Which these should automatically show up on the Zoom. So if you have the Zoom, you'll see the Zoom open, you'll see them. And then we have the bulls are essentially sitting about here. So this is where our positions are. I don't think the bulls really have a stop because of the insurance that we marked out. So I'm not marking a stop for them. So in a situation like this, where you have this range and a launch out the top, we see this a lot. This is a very common thing to happen. You have boxes and lines, right? You have boxes, a line, and you have a box. And the question is, how far down does this box go? And my favorite place to mark out the top of this box is you look for the loser, the one that started it, the one that did it all. And the best spot that I see for a loser is right here. This is the best spot. That's where the bears will be sitting. We didn't have bearish samples through here. So this is the spot where I think that the bears are going to be sitting at. And they're going to define that. If we had seen a bearish sample here, I'd be marking that out and say, you know, this could come back down to that level. Or here, it's the group that started it. And I think this was just looking and looking and looking. Otherwise, the next level would be the group that's holding it. So, I mean, this is pretty simple stuff. But for the top side here, it's not the highest one, it's the first one. And that just happens to be here. There could be a bunch of bears through here. I'll mark out the first one because I'm like, you guys are the troublemaker. You're the primary target. With the other side of it, I mark out the best, which sounds like the lowest, but you're going to have to look at it and use your judgment. The spot that is best or controlling. So you're going to have to use your judgment. It usually is the lowest one in the range, but it's not always. So for me, it's the group controlling that range. In this case, the bulls who have the spot that's dominating this range, and they're obviously the ones who inspired it and caused it. So we can see that. You can also see that this spill overnight went to the VoLTE-WAP. Right? And this is a common thing. It's not something I really point out a whole lot. I think it's a secondary, tertiary type thing, but it went right to the VoLTE-WAP there, gave us a signal, which was a pretty good spot, and then shot back up. So this is our layout. This is the geography that we have here. We know where they are. We know who's doing what. We know who's in, who's upside down. We can see probably where their stops are sitting if they got hit. And I think the objective here is just simply to milk all the bears for as much as you possibly can. The other thing that's really important about this is, I think, because of, remember this right here, the insurance policy, the fact that these guys are insured with, some puts right here that probably, cost them here. It doesn't even matter if they're holding on to a positive spread, like the premium, the strike minus the premium. If this is just equal to, it could be greater than, and this is of course with puts, greater than or equal to your outright. In this case, it's a long. So even if it's equal to, it's still insured. There's no losses there. You can't generate losses out of that. So I don't know what they could have paid. I don't know what they paid. For me, it hasn't really played a huge role in this. I used to think that you should calculate this, but my assumption is that if you're in a trade that goes positive and you convert that into after it goes positive, not like you get into a long and then and then you get an in the money put. No, you need it to go positive so you have some actual rotating profits, and then you convert those profits into a premium that this practice ensures lows. And I think even if the premium's past your position, that an institution is going to say, we hedge the risk. Sure, we're carrying like a negative amount, but the idea is, and this might all options traders understand, that you can have something go against you and you could still cover your premium and get out with, I don't know, half. So if you get out with half, you lost half, but you also get to keep half. And as long as that half covers, here, you can finagle this kind of math. And I think institutions sort of think that way. I prefer not to, because it makes things a little bit more complicated. I'm just like, if your premium is above your thing, it's for sure a positive spread. But, maybe you do a little bit more volatility calculations and you're like, I'll be okay with this. Anyway, so you can see the layout here. My expectation is that these guys here, they're Trailblazers. What do we expect from Trailblazers? There's one thing that's really important about Trailblazers. Trailblazers, they're the first in the group. They're the first people. They're the first ones. So they have a high risk reward situation. If they're right, they get a lot. They were at the beginning of the trend. They started it. Oh my gosh, it's amazing. But their risk is really high because they could just get hit, stopped and stopped and stopped and stopped and like you can just death by paper cuts, just constantly getting. So you have to be careful with Trailblazers because I think they're gutsy and we need them to start trends and to get things going, but they're also the major source of fueling trends because they're constantly on the wrong side. So I think these guys are the ones to think about here. Did they dump? And I do see a little bit of an acceleration there. I'm not sure that it's much. I don't know that I would call what we just saw a liquidation. It looks like it just moved against him and made him sweat bullets a little bit there. I'd like to see this move up and really give us that pop that hurts. For the downside, okay, so this is all upside. We've covered that. I think that the objective here is to knock these guys out to optimize how much we can get out of their accounts. To the downside, if bears want to win here, what they're going to need to do is find bulls. Where are the bulls? Well, if this scoots down a little bit, there would be bulls right here. That crosses over, we get trapped orders. Otherwise, decay is going to have to move all the way up and go like that, and then we could get a bullish sample there. Or they could just run algos market wide, which I think would be really stupid at this point, and try and get tension down to zero. But there's no way they're going to be able to do that today. So this is off the table. This is off the table. This is the only option that we have. And then what you could do is just sort of eyeball it. You just say, well, moving down this would cost how much downside to price? And how much downside to advanced decline? And then you get an idea just sort of how the market's been moving. You get a rough estimate pretty quick about what it's going to cost to do that. And in my opinion, with the amount of time we have left, which is about 45 minutes, got 45 minutes left. Driving this down from 10 means you're going to have to do 200 or more ticks on the advanced decline. Simple. So that would get us to, I'm going to say like 200. And driving price down, they probably have to get it down to the low of this mid-range, which would be 13 points. Okay, so of all these, 13 points is probably the easiest one. I think this is a little tough with the 45 minutes left. I think this is the biggest issue right now, is that we're out of time. You could drive 13 points, but do you have time to do all the stuff you need to do? You could drive 200 ticks, but do you have the time? And there's just not a lot of time. They'd have to bring this down, find some bulls, get the market to come up, show the bulls didn't act, grab a bearish position again, run those bulls out, and then attempt to get through this low by the close. Because if they don't get through that low, I think that would show that the bulls have remained in their position insured, and it's going to shoot back up over. So this is a lot of work. I don't think they have the time to get it done. And I think that we saw them immediately get crushed earlier. Why would you expect the bears to be successful now after they got immediately turned upside down just a little bit ago? And the bulls are insured. It just looks terrible for the bears. There's just not enough time. So at best, I think if the bears are going to pick up control of this market, which is going to be tough, that's going to be next week. Thinking about that, you think, okay, well, what would have to happen? First of all, 30-minute tension is at negative 8%. You're not going to convince the bulls to move. Because why would they? I mean, if we were at negative 45%. Even then, you'd be like, well, you can't run a whole day tomorrow. You'll be running into 60 or so, and it'll get too hot, and then you guys will need to let go. 8% though, it's like, well, you guys could run 2 or 3 days of a bullish trend on 8%. So why would the bulls not? So convincing the bulls to move out of the way to allow some elasticity becomes a problem, right? Because if the bulls move out of the way right here at 8%, that means the bears have the whole afternoon to drive this thing down. Why would you do that? You want to let go when tension is, up here, and then the bears can drive it all afternoon without crossing over zero, and then you can pick it up after they cool. So 8% is not a very persuasive level for the bears to gain control of the market. Now, that's not to say they couldn't do it. So the mechanism here is not going to be elasticity. If the bears are going to drive this over zero, they're going to use brute force. They're going to run algos. They're going to hit the market. They'd run a news program or something like that to try and get tension to come down like that. It'd be something like a gap tomorrow or something like that. But even then, the question is, will bulls defend? And I don't know why they wouldn't. We haven't seen the bulls have any issues. They're enjoying their control over the market. So I would anticipate the bulls actively attempting to defend 30-minute tension if it popped under zero. I mean, the last time it did it right here, they came in and defended, and that was the low. While the tension did meander its way lower, clearly they were perhaps just waiting, or like I like to say, being predatory, allowing the market to sort of move down while they were positioning. So I don't know why they wouldn't. I don't see a great case for the bears. I want to make that clear. I don't see a great case. I know that I've heard some things and people saying stuff and all that. I'm just not seeing a great case for the bears right now. They have some things to overcome before that they look like they have a really good prospect to be able to get into a position and drive the market. I see a case for the bears to get manipulated into holding onto their position as much as they can, and then it shoots through the roof. That's all I see for the bears at this point. It's just too far. There's not much to be done. Now, that being said, the bears could come in and decide they're going to run an algo, but even if they ran an algo, just think about it. If you ran, from what you've seen with tension, if they ran a huge algorithm looking at the way that tension's been today, do you think that they could get tension through zero by the close? I don't. I don't think you can. So I'm not anticipating that. Of course I'm not, because they can't do it. So if the bears run an algo and they decide to just slam the market down, it's going to get immediately rejected back up. And all the capital that you put into your algo is at risk because you're unable to create a market condition that's favorable for the bears to drive it down. And the expectation would be that shove down was maybe to unleverage a bad position or something like that. And the bulls are going to treat it like an opportunity, not a risk. They're going to buy into it. It's going to shoot it right back up. And if you're not nimble, all that capital is going to get trapped in and it's just going to fuel the fire. So I don't think that the bears should run an algo. Now, I've said that before, then the bears just show up with their dumb algorithms and then it gets rejected. And I'm like, why did you guys do that? And it's really irritating to see that. So they can. The point is to interpret what it's going to mean for that group if they do, and then to assess the situation and try and decide if they should, and if they do, what that means. And in this situation, I don't think it would be successful. I don't. I think that it would turn into a bounce. It would shoot up. I think the objective right now is to do the little pop up sideways. This is the range where there's doubt. There's a B in there. There's doubt. And that doubt is equal to the amount of time that we're stuck here. We see this all the time. It's the same thing pretty much every day. It just looks different, but it's the same stuff. And that doubt is equal to the amount of, I don't know why I drew an arrow. The amount of time. So we could say time and what the human brain does when you're faced with situations where that you have risk, you know, your risk is being affected by doubt, you are inoculated. Meaning you get more entrenched in whatever you're doing. So if you're long and you think it's going to go up, you're more convinced. If you're short, you think it's going to come back down, you're more convinced. And the whole objective of inoculation ranges is to shove that stop loss up higher, because the more convinced the loser is, the more, you know, your conviction, and this is bad math, so if you ever catch yourself doing it, watch out. Your conviction is equal to your stop loss. You say, this is a huge trade, so I can risk 20 points instead of 10. Well, if your huge trade isn't paying out, all you're doing is increasing your losses. If you get to a situation where that you're in here and you're upside down 5 points on a trade that you thought initially was worth maybe 10-point stop, and you're now convinced that you should have a 20-point stop, you are being inoculated. If you're in a trade that, you know, if you had gotten in short here and it was down here right now, and at this point, you're never asking the question, well, should I move my stop? No, you never, you would put it at break even because you were right. And so when you get into losers, they try to inoculate you into expanding your stop loss, and you just should never do that, ever, ever. Your initial conditions when the trade happens are the conditions you need to abide by. August 2020 feels. So this is kind of interesting. Options, did you see these right here? So these ones here are in the money. Now, this is important because placement matters. These guys, bullish position, insure. Their insurance position right here. Because it was above it, you know, they were making money. They converted it into an insurance position that would capture those gains. This is on the wrong, like if it's all basically loss. So I guess maybe they insured their position to just cap their losses for the day. Maybe that's what happened. But you insure a position after your position has winnings, because then you're converting your winnings into an insurance policy, and that's wise. So this just looks dumb to me. This just looks like cash being injected into I don't necessarily think these are related. I think this position is going to get liquidated, but it is interesting to see all these options coming in here, probably because it's Friday too, but these are in the money ones. So they're going to be, you know, their premium, the strike here, which I call the break even, the BE, is going to be about here, or maybe a little, I don't know, somewhere up there. So they're not going to be able to, they're not insuring their position. At best, they're just capping their losses for this trade. And there's no way to win, because if this moves down, they're going to lose the value on this. You know, I guess there's a lower limit now. They can't lose into infinity. But we were never looking for infinity. We just wanted your liquidation. That's all we wanted. So in my opinion, buying those calls right there, where your trade is upside down, is just injecting your losses into the market before the market rallies. And okay, whatever, it doesn't matter. I mean, the losses are captured, so the market's free to move up now to where those are at. There's just no reason to move down. So that's kind of interesting. You don't usually see that kind of behavior out of bears, admitting that they're wrong, and instead of liquidating, they insure. But it doesn't stop the market from moving up. Your loss is your loss. You always have to pay for your mistakes. So looking at this, I think this is also interesting. We had the market sort of inside of the range, and then finally we get our bears showing up right here, and that helps the market move outside of the value areas. For me, this is confirming that's what they were looking for. We were looking for some bears to pay for a decent move out of the top. As soon as we found them, the market was able to get outside the range and move. You can see the value area is staying pretty close to price. And so you can see, by contrast, when you expand, or when the market's, you know, found a sucker and is moving directionally, expanding, you get away from the value area. See that? So you get this area in here, and that lets you know that it's what's kind of going on. We've got somebody upside down. We have things, it's moving, it's going somewhere, something's happening, versus a market that gets directional and doesn't get outside of the value area. Here we go. This one's okay. You can see it sort of, it doesn't really stay outside of the value area. It's kind of hugs around it. So this shows you there is volume here. This is a V. There's volume. And so, but if you were to imagine the point of control might, well, we could see it, it's right there, like that. And then as you're going up higher, that value area is continuing to stay sort of full. Where on the other one, you know, the value area is getting more narrow because they're not finding volume. So they're hunting, or it's looking for something in it. And I anticipate this to stay that way. We stay outside of the value area, moves up, finds the liquidity, and that'll help you go, oh, well, why was it doing that? Well, it's because it wasn't so much that it was finding volume, it was going somewhere. And in this case, it's the liquidation of the bears as much as we can get them. Looking over the rest of the market, oil, interesting, I suppose. That's about it. Nothing else actually looks all that interesting to me. So right now the game is, are these bears going to be able to do anything? And I think the answer is no. I think that they are absolutely neutered. They're done. They lost the game. I don't think that that's a good idea. Now, I do think because of that insurance policy we saw right here, which is maybe associated with that, that's probably going to cap the upside a little bit, in that we won't be going like, oh, let's just go forever. But because the position was upside down in a loss and they insured a losing trade, which is dumb, just looks to me like injecting capital into the market. And so your upside's probably going to get limited to whatever we can find, and then it's just going to be done into the close. So I don't expect an explosive close, but I do expect the market to keep pressuring the bears, and I'll keep watching tension right into the close to see if we can get like an acceleration up to show those bears getting liquidated out of their position. And then we know who funded this move up. Let me pull up the tick. I don't think I have any. Okay. Because the market's open, this will take a minute. So we look for any inversions and see if we can find something like that in the market. Otherwise, if you're in a position today, if you picked up anything through here and you held on to it, at this point, looking right here, my expectation would be to see, I don't think that this is the leg. I think this is the leg, would be to see a leg like that. About like that. And at that point, I think if you dumped your trade, you caught the meat and potatoes of this position and you're able to take advantage of the bears and you're done. If the market darts down, I think the whole objective would be to just try and squeeze out any weaker hands. So I wouldn't take any losses on this because it's going into the weekend. If the bears decided, hey, we're going to get really gutsy into the close and they drive this all the way down, they're going to be looking to get it down to here if they can. I don't think it would continue, but over the weekend, I think it would be a bad idea to try and hold on to it because I don't think that holding on to things over the weekend is a good idea. I don't expect that. I expect the market to move up and give us a second little leg here to try and pressure these bears out of their risk tolerance. Man, tick still hasn't loaded. So it's just a waiting game. If I were holding a long position, let's say from here, I would probably have my break even sitting about here. That's where I'd be sitting at. And as this breaks through the high, I wouldn't be tolerating a move back down. So I'd be moving my position up to here. And then as it moved, I like to just hit the exit button. I just click it. As soon as it gets to where I want it to go, I just go close. I will use limit orders and stuff, but when it comes to like the time to actually exit, when things are where you thought they go and all that stuff, and you see the behavior, I just click close because I think that's for me, that was the behavior that was the easiest to manage. All right, our tick chart loaded. I'm zooming in on it a little bit so we can see it a little better. And see, here's the open. Are these regular bars? They are, okay. All right, so off the open is where that is. So we're sitting at the inversion level, which if you remember, I don't like inversions that happen into lows. I like them out of lows. So this structure is not my favorite structure. Because this was, in my opinion, into the low. You have your pivot here. I want to see the pivot show up here or here, or something where you're coming out of the lows. You get your pivot. Those are the ones I like, not these ones. So not my favorite inversion structure. Okay, cat. Something else that's kind of interesting is this tension you see. I'm zooming in here to take a look so you can see that our projection is at about the same. You can see like the projection line is almost looking like it's going to cross over if you were to extrapolate that out. See how that works? And I've noticed that this is something that happens. Your projections are down and then they start to cross. Like you have there. And I don't know if it's something that you would say is a signal, but it should happen. If you have markets getting directional, you should see projections change direction like that. So this moving up to here, you would expect that. If you're going to see the bulls come in and take control and wipe out the bears, you should see the projections for tension and stuff change direction and your projections go in the other direction. And if you remember, the bears came in right about here, so the projection changed, well, just a little bit before there and started to move up. But I think that's an aspect of capturing one side and stuff like that. So if you're sitting in a position and this is inoculating you, good, it's supposed to be. This range looks like an inoculation range to me. I used to call these the drip and rally. And the reason is because the market would come up, you get a sell position, it was always a bearish position. You do something, and then you had this feeling of a drip. Like it would just go bloop, and it would hit right to the back side of whatever your position was, wherever the masses were trapped. It drips, you had this really fast move, and then you get this rally. It was slow, and then all of a sudden. And I used to call this the drip and rally. And it was just so consistent, your experience being a bear, that call it drip and rally. All right, so pushing through this level, is that 41.80s? We see like an 81 here. We're pushing through. I'm going to be looking for a sweep. So I want to see, you know, I'm watching this and the numbers will be like 79, and then 79, 25, so on until you see like 80, 25, 80, 50, and all of a sudden it just says like 82.50, and you're like, whoa. And those sweeps are like 2 to 5 points that just all of a sudden are so frequent when you see a group get liquidated. You just sort of watch it and it just flickers all of a sudden. You can see it on a tick chart or something like that if you're looking at those. They look like, usually look like this. And the market is like, are we going to come down and retest that? It doesn't really matter. The point was that this right here tells you that somebody got liquidated. This is what they'll look like. And numbers wise, it'll be small numbers like 5, 10, and then you get these huge numbers like 1,000, 1,500 or something at each tick on the way up. And you could see right at the top of the sweep, there's like a number, and you're like, clearly it was just sweeping up to hit those numbers. But you don't really need to look at a tick chart. If you're just watching, you can tell. Looking at the options, something that I've been tracking, you could see that yesterday here and here, we have 156,000 calls and 140,000 puts, which I think is pretty high. Most days are between like 20 to 50 or something like that. And that, so this looks like high. And you can even see that it was like 159% the previous day's volume. And this one's 69%. So decently high compared to the previous day. And then you look at today's and we're at 80% lower, 80% lower. So much less options volume. And the general rule that I use with options is that on the way down, you have higher options, and on the way up, you have lower. And the idea here is just basically the market's going to push down until you insure. And then once the market's no longer insuring, it moves the other way. So it's, you know, insure your position. You're like, no, and then it starts falling. And you're like, oh, maybe I will. So seeing higher looks to me like people insuring stuff, you know, hedging bets and things like that. Even though prices weren't falling, that's what it looks like to me. And then seeing today drop down to like 25 and 30. Somehow we found a ton of the option volume yesterday. All right, we're 81. Right there, we're popping through here. So we're looking for the sweep. Remember the sweep, the pop up? It's going to pop. When you see that sweep and it's like a, just all of a sudden, you'll know it when you see it. And then we're going to keep our eye right here, look for a nice little curl up. You're going to look at this number, say, all right, 500, right? When we get through this level here, you keep your eye up. It's like 500, and then you say, you know, if that all of a sudden says 600 or all of a sudden a higher number, that's something to pay attention to. Just waiting for that event right here. That's what I'm staring at. I'm just staring at this number. Going, come on, let's see it. Let's see our little sweep. Let's see that sweep. Where's the sweep? There was some, well, I don't know. I see these things like that. These out of the money calls, you know, they're like come in like little stacks. And I don't really pay a whole lot of attention to them because they're just all the time. They don't seem to impact much. $82, $82.25, $82.50. Give me the little bloop. Well, it's looking pretty good though. I mean, you see the drip and rally though? If you were watching this in real time, you should have seen this. It was like you see these bars right here, they're like a drip. They go whoop, and they came right back to the backside of the main bearish position, and then you get that slow move up, and then whoop. So it happens so frequently. Like it feels like a drip, and then a nice little rally up. So we're just sitting, it's still 500 here. Yeah, buddy. All right, so not much going on here. -16. The tick is just sort of hanging out. Yeah, Pierce?
Can you actually get? Can you get me some milk?
You want some milk? I'm gonna get him some milk. And watch that 81 for pop up there. Or if you see the advanced decline, look at the advanced decline starting to move. So keep your eye on this. Just a second. All right. Is that it? That was the whole thing, huh? Leg and leg. I don't know, last 15 minutes this for the week. This is the tough part. Looking at tension, all my instances of it, the advanced decline. Could see a little acceleration right there, but I don't think that was hitting it, and I don't see acceleration yet. So, this is going to be up to your judgment. Last 15 minutes, you want to hold on to try and see if you can capitalize on hitting, liquidating these bears. Otherwise, at $81, this is a good spot. You captured most of the move. You got your second leg. This is a good spot to get out with 15 minutes into the close, and you could say, this was good. We caught the idea that was developed and able to take advantage of it. But without the acceleration on tension right here, ooh. Go to California to go to Legoland. Sorry, I'm very interested in going on a vacation. Okay, so if you want to hold on and try and capture that, you're going to be trading the idea. 15 minutes in the close. Things can get wild at the weekend. I think this was a pretty decent little pop up, I guess. Wasn't that amazing, I suppose. Only a couple points. So it's up to you. What would answer that question for me is if you are trading this idea or if you are just looking to scalp some cash. If you're just looking to scalp some cash, it's a good spot to get out. If you're trading an idea, it doesn't quite make sense to get out here because we didn't see the bears get liquidated, so they're still holding on to their positions, and so we still need to test that risk tolerance. We still need to see this move up and hit that and accelerate tension into the close. Yeah. Is it- Coming back down. Oh, look. Well, no, not much going on here. That's out of the money. I think maybe this has given us a little bit of trouble because it caps the upside a little bit there, but our value area right here, so we're expanding. Still. It was a pretty sharp move up, sharp move down. Yeah, I still don't see the acceleration here. That's the thing that we need is the tension to accelerate. That's going to show you the bears got pushed out. Just nothing on the tick. It just doesn't even care. So none of this exciting. Just not exciting. Last couple minutes. All right, be back in just a second. Give me a second. Okay. All right, so we got a little move up. Oh, back to 82. Right when I get back here. Still looking for that little move. 83. This is probably behind 49 or not that much. $10 minutes. We got. Show me what you got. Take out those bears. It's a little squeamish. Why are you squeamish? 9 minutes left. You can do it. What is this? A little, I want to see it go, I want to see it, something like that. That'd tell me they got knocked out. Still at 450 right here. So see, we were at 500 this peak right here. Moves down and comes back up, and we're at 468. Less traction? Eight minutes. Might be all we get there. Maybe. Look at the Volti-Wop. Just as soon as things start moving in the right direction, you see this moving up from all that volume and volatility that comes into the market. Sweet. I might be going to Legoland here pretty soon. Yeah. I'm thinking the trouble the market's having is this. I guess I don't need to zoom. This, the in the money calls, right there on the. You can't see it because it's scaled a bunch, but they're right there on the backside of that bearish position. I think that's what's giving this market trouble, is that the upside has been limited, and so it's getting this like shoot up and draw back down thing because the upside's capped. It's known. I think that's the trouble that we're having here. So we still didn't see this. This is the thing. We still didn't see the bears get their position liquidated. Six minutes. 6 minutes. What are you going to let the bears do something here? No. Why'd you do that? What? Thought. It's still going. My streaming software just disconnected and reconnected. Never had that before. 76.50. 4 minutes left. What's the play? $76. So what I'm looking at here is I'm watching this. They're right here on the backside of this bearish position from earlier, and so with the, this is going to be the top side of the range. If the bears are going to decide to try and come in here and execute some sort of algorithm, I think the goal will be to hold it down into the close, to pressure out anybody who's holding. I don't think that the bears got knocked out right here. It doesn't look like that happened. They're still holding, but they're running into a problem because the bulls are here and they're very well positioned. So running algorithms right here just looks like this is a sad face with, it's a bad idea. I think that's a terrible idea, but it could benefit both parties in that it will give the bears the opportunity to unleverage anyone who happens to be stuck here, while giving these guys potentially some opportunity to pick up positions. But I don't think this is establishing any trend. I think what this is doing is potentially pressuring weaker hands or something like that. I still think the bears are sitting right here. And yeah, we got to about what we wanted. We got the 2 legs that we wanted. What I didn't get was indications that they let go of their position when they were upside down. So that's a problem. And that's what I'm looking at. If I had seen this accelerate upward, I'd have said, all right, there it is, dump, be done. And then I don't care what they do. If they want to run this down, if we had gotten that here, I'd have said, or even here, I'd have said, oh, there it is. But in this instance, we didn't see that. We didn't see the bears let go. So as far as I could tell, they're still sitting there. Probably feeling pretty good that the market went up and came back down here, right to the VoLTE-WAP. No. Two minutes. Let's see what happens. Right into the close here. These bulls can do, these bears can do. Tell you what the bears can do. I don't see anything exciting going on in any other markets, really. Well, this isn't gasoline anymore. Gasoline's GC. Or no, it's not GC. Sorry, that's cool. It's, I forget. Something. This is kind of interesting. Look at the volatility here, meaning the standard deviation or the amplitude. See, and then we get sort of this, but then it turns into this kind of stuff. From about here to here, this just kind of looks different, doesn't it? Looks a little different. And market's closed. Still haven't caught quite up here. 59.7. But yeah, market closed. So post-market, was it a push down to hold out people and then we see a pop-up after? I don't know. Doesn't matter. Hopefully at this point you're able to take advantage of some of the moves up. I tried to point out a spot where that around 81 or 82, if you're looking for making money, that was a good spot to get out. Otherwise, holding on for a narrative trade is a lot more difficult. I still think we have the bears sitting right here, bulls sitting right here, and there'll be a couple of minutes, 15, 20 minutes. Sometimes it'll go on for like an hour or two after the market closes. This will still tick around, but there's a couple minutes in here where we have futures move around. I don't like to depend on this particular time. I think this aftermarket session right here is a weird time in the market because I think brokers call each other. They look for things. It's just a little weird spot in here. So I personally don't hold over weekends unless I have an insured position. So here's where we're at. We close at about 75. I think the bears still need to get knocked out of their position. And if they don't get knocked out of their position, then what they're going to need to do is drive this down, find some bulls, because they're going to have a difficult time with this particular low without trapping in some bulls. Like, you know, it looks like this. You trap in some bulls, probably bears come in, and then drive it down to wherever their stop is. Try and stop them out. That's the way you get through those lows. If there's no bulls on the way down, any move down here is just going to get rejected because it's insured, so there's no money down there. Unless there's some big event that I don't know about. Currently, this looks to me like the market was just being a little pathetic. I think this could have popped up like that and knocked out the bears. Tension would have come up a little bit and we'd been good to go. I don't think the bears have a good foot here, but we'll see. Going into Monday, if they can trap in some bulls and then have a position that's relatively close to the high of the market, they might be motivated to do something, but I still don't think it's going to work. Tension is not high enough. They need tension to convince the bulls to move out of the way. So I think the bulls are still sitting here, still bullish on this, but you have to pay attention to the opportunities the bears have, how they can get it down through those lows. Otherwise, it just creates opportunities. So I still think this looks like opportunity. This move down looks to me like it's just going to pop back up. And probably next week when the market reopens, we'll move back up through the highs. And if you decided to narrative trade or trade the idea, then seeing, you know, if this moved up over the weekend or something like that, gets up here, this is probably the place that you would dump your trade or insure it to hold on for more. I don't know, whatever it is that you'd like to do at that point. So that's where I am. I'm bullish on this. See you guys next week.